In a calendar spread, we know that the front month, in other words, the month that is the very beginning of the very nearest month to the expiration of this particular underlying stock, is June in this case, which has 27 days left. Now there's also June quarterlies over here, and there's another June in here. I think it might even be a weekly. I don't know what these are, but they have a lot of different kinds of option contracts. The one that we're interested in is the ones, now those aren't weekly because they have 27 days left too, but the ones we're interested in are the front months. These are called the front months. The very next expiration month is called the front month. So what we're doing is we're selling an option, and of course, because we don't like unlimited risk, we also want to buy an option, right? Just like in a vertical spread. Well, in the case of a calendar, the only difference is instead of buying a option in the exact same month as the one that we're selling, we are going to actually go into the next month, which is July, and we are also, and then we're going to buy the exact same strike price, only a different month. So we're selling a June 138 call, and we're buying a July 138 call. Let me show you exactly what would happen if you did not buy that call in July for protecting your June, the sale of that June call. Let's analyze this. You can see that if the price stays the same or it goes down like you intended, you would collect the maximum profit. In this case is what you sold this option for of $2.59 or $259. However, because you do not have any protection for that option that you sold, you have a theoretical unlimited loss potential on that option if it goes against you. Because you sold a call option, you want the stock price to go down. But what happens if it goes up? Well, let's take a look. If it continued to go up and up and up and up, theoretically it could go to $1,000, I suppose. Although this is an index, you would have a maximum loss of $86,574, which is not a pleasant thing to have happen. So we do not sell naked options. What we want to do is we want to protect that position by buying another option at the same strike price, only in a different month, and this is called a calendar spread. They call it a calendar spread because you're buying in you're selling in one month and you're buying in another. So let's analyze this. This is what the graph of the profit potential of this position looks like when we have both the sale of the call and a purchase of the call in the next month out. The purchase of this call provides us with protection, because if the price were to move against us, we would have a limited loss on the position. Our maximum gain and maximum profit on the position is achieved at the exact price that we sold this call for, which in this case is the 138. That's the strike price of the call that we sold. We would achieve the maximum profit if at expiration this stock remained exactly at 138. We have a fairly wide break-even range here between 142 and 134 and a quarter approximately. So in other words, the price can move within this particular range and we would still achieve some profit. However, unlike the naked call, we also have limited risk to the downside. If the stock had gone up to 1,000, like we had in our previous example, the very most you could lose on a calendar spread, on this particular calendar spread, is $136. And I'll show you why it's only $136 in just a minute. Essentially, what you're doing is you're protecting the one that you sold with another one at the exact same strike price, only in a different month. So you're hoping to achieve the maximum profit in the theta decay of the front month option that you sold while trying to maintain the value of the one that you bought in the July month. Because let me show you what this looks like if these options were put together on a graph. You can also see, but in just a second, but you can also see that theta is positive at $1.26. So even though you're buying an option, you're also selling one, and that even though they're at the exact same strike price, because they're in different months, it gives you a positive theta. Also very interesting is, unlike a vertical spread that you would sell, it also gives you a positive delta.